Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number over here, and you can give us a call right now, and we can talk to you about your mortgage, because I know those things are important to you, and I know the decisions you got to make right now about what your real estate needs are. Yeah, they're going to impact everything you make in the future, about where you live, about where your kids are going to live, about where your in-laws are going to live, where your kids coming back from college are going to live. Very, very important. Real estate is the number one way people get rich in this country, and if you are one of those people who want to get in on it, you have to decide if you're going to get a mortgage, if you're going to pay cash, how you're going to get a mortgage, how you're going to qualify for it, and all these things are so important that we want to dedicate this show and all the shows to that so that we can help you make decisions, because the decisions that you make today are going to impact the rest of your life, right? We've heard that said so many times, whether it be in whether you go to school, whether you go to college, whether you get out of high school. I mean, all along the way in your life. But this decision can impact financially. Now, there are ups and downs in the economy, and I want to talk about that right now. The economy. What's happening with the economy here locally and here nationally? So San Bernardino, Riverside counties, where the show is being broadcast, your economy right now is looking pretty good. Manufacturing is good there. Obviously, blue-collar jobs are on the uptick. White-collar jobs obviously are as well. And what I mean by that is banking, finance, anything having to do with real estate or mortgage, anything having to do with high tech. All of these jobs are at the premium right now in San Bernardino and Riverside. Blue collar jobs as well, construction, maintenance, driving a truck, things that would be considered something that you wouldn't need a high education level, but certainly skill for. And then lower skilled jobs, i.e. the day laborer, the gardener, perhaps, somebody who just picks up and moves stuff around. Those jobs are also on the high uptick. Why do I bring this up? Because we are looking at real estate prices, which have actually steadied, and in some places in the country have come down and continue to go down. Zillow last month, they came out with a report that showed that 15% of the properties nationwide are reducing the price of the property. What does that mean for you? Is that there's opportunity coming. There's less buyers now. And what happens at the end of any long marathon? Anybody seen a marathon? I've been in several. I wanted to do the LA Marathon last year, but just didn't get a chance. I've done the Boston Marathon, the Phoenix Marathon, the Portland Marathon, to mention a couple, three. Well, at the end of every race, and I don't care how fast or how slow you run the thing, but at the end of every race, what happens? You get tired. And let me tell you something. Mile 22 to 26, you want to crawl. You are so tired, you can't do it anymore, and you just want to quit. That's kind of where the housing market is right now. We are at the end of a really long up in terms of how prices have been escalating throughout both San Bernardino and Riverside, all across Southern California, certainly Los Angeles, anything on the west side, and all the way up through San Francisco. We broadcast this show all over the place. I mean, this is an internet-based broadcast too. We also are on YouTube and themortgagevoice.com, as well as KCAA, KMET, and K-Tahoe, which broadcast the show each and every week to you, and I want to say thank you to those great people. So when we talk about national trends and then how it reflects here locally, what we're trying to do is to understand the microcosm and the macro in what's happening in the marketplace. And my research on each and every week, we try to bring to the show, as everybody knows, people from all over the country. We had last week LaWanna Bradford from Georgia. We've had Maggie Miller. She's from North Carolina. We've had people from our office in Florida, as well as Illinois and a number of other states. We're also in Texas and Nevada and Wisconsin. And again, I say we because Malibu Funding is my employer and also the sponsor of this show. I want to thank those nice people for doing this for us. So So we bring this information to you. And what it says to me is that across the country, we are seeing a decline in the rise of real estate prices. And that means that we are coming to the end of the marathon. Now, does this mean that you're going to fall down flat in your face and it's over? I don't think so. But I think the 6 to 8% to 12 to 15%, which is what happened in Las Vegas last year, I think those kind of increases are not going to be sustainable. And as we're seeing in the marketplace, buyers are pooped. They're done. They can't handle it anymore. They don't want to go out there and look for properties that are $50,000 to $100,000 over their price range and then try to squeeze their foot into that glass slipper. It's just not working. So they've given up. Millennials have given up. A lot of the people in the marketplace right now are people who, are patient, who have the type of personality that can wait. But many, many people do not have that personality. So what happens? They rent. And what happens to the rental market is quite a bit different than what's happening in the real estate sales market. So in the rental market, we are seeing a very steady growth in rents. And all across San Bernardino and Riverside counties. It's not boding well for anybody who's coming out of college or who is entering the workforce out of high school, or is somebody transitioning from one job to another and they just can't seem to afford a down payment on a house. You got to live somewhere, right? So rentals are going up because the demand is there and because people have given up their search for housing. I talked to a long-time client the other day, and I hadn't talked to her in about 4 months. And the reason I hadn't talked to her in 4 months is because previous to the time I did talk to her just a couple days ago, we saw about 50 houses, and we put in several 10, 15 offers. And the reason that the houses weren't purchased, we got into escrow on a couple, but as always is, buyer's remorse, of course. But there's problems with houses when it's a seller's market. There always is, and sellers just don't want to be on the hook for anything. They don't want to pay for repairs. They don't want to help you with down payment. So the problem with that, of course, is when you're in that type of market and you are a buyer, you just get burned out at the properties that just aren't what you want, or you can't negotiate something that would make the property desirable for what you want. So you give up. So I talking to my long-term client, and I called her and I said, "Hey, how you doing?" And she says, "Fine, I was thinking about you." And we had a nice chat. And this is well a part of what we do both in the real estate and mortgage world, but also what we do in life, right? I mean, you haven't talked to a friend, you haven't talked to somebody, you call them up, you see how they're doing. Well, she seemed to be more ready to get back in the market. And I talked to her about how the market has changed in the last 4 months. And she asked me why. And I said, well, because what we've got is a changing marketplace whereby sellers are more apt to reduce their price than they were 4 to 6 months ago. And the reason is that the buyers have disappeared. And we've discussed this in this segment, why the buyers have disappeared. So if you're out there and you've got kids, I know your kids are in school, you're set for right now. But let's say that you are still curious about what's going on in the marketplace and how you might be able to take advantage of perhaps a little bit of softening, a little bit less of the arrogance of sellers. And we can call it that because when someone is the best and they get what they want, they turn arrogant in their behavior towards others, especially those who don't and haven't. So if you're out there and you're thinking about getting back into the marketplace to look around to see what's available, I think in September, October 15th to Christmas is going to be a tremendous opportunity because you're going to see prices drop, continue to drop. There'll be less people in the market, and desperate sellers will be more willing at that time to be able to negotiate with you on price, on terms, and perhaps get you something which 6 months ago might have seemed impossible, but right now is a pretty good deal. So if you've got the patience and you've got some coin in the bank and you can qualify, this is an excellent time. I'm Jeff Barton, of course. I really appreciate everybody listening to the show. We'll be here each and every week as I wend my way through the complicities of what's going on in the real estate market. Thanks very much, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, Email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number over here. Pick up the phone, give us a call. We talk about mortgages primarily on the show, but really anything that affects real estate value, and how you're going to be able to afford what you can't currently afford or what you might not think you can afford. That's what we talk about on the show. Rates have been going up, as we've talked about before, and they will continue to go up, although the last Federal Open Market Committee meeting said, no, we will not raise rates. And we have the president chiming in on the Fed and why they're doing what they're doing. It's always a balancing act when it comes to whether rates go up or rates go down, and sometimes it's connected to the Fed and sometimes it's directly connected with the bond market. But as we talk about all the time on this show, opportunities abound if you know what to look for and have the right people around you that can help you decide what to do and when to do it. That's what we try to do on the show, and thanks very much for listening. With us today is a first-timer on the show, but certainly not a first-timer to her field of expertise. She's a certified reverse mortgage professional, Nina Penny, and she comes to us by way of several different places. I guess Arizona would be one. California is another. Nina, how are you?
I'm great. How are you?
I'm just great. Thank you very much, and thanks for coming on the show.
You're welcome.
Okay, let's talk a little bit about your field of expertise. Tell us a little bit about, one, your certified reverse mortgage professional, I guess your whatever that designation is, what it means, and why it's so important that people understand you for being associated with it, and then, of course, how you can help people as a benefit from that.
Sure. That's quite a big statement, but yeah. Basically, a certified reverse mortgage professional. I got that title about 2 years ago. I've been doing reverse mortgages for about 14 years.
Right.
And I wanted to do something to stand out from all the competition. And I felt as if I was a real professional, and so to back that up, I went and I became certified. There's only 151 in the United States who have that certification. Where I think we take it a step above. We're really concerned about the industry, concerned about the people we help, educating people. It sets us apart because we know all the rules and we know all the ins and outs, and we know how the process should go, and hopefully we make it a lot easier for clients when they decide to go with someone who is certified.
Now, the reverse mortgage product has always had a stigma attached to it. I think we on the show have tried to dispel that for as long as we've been on the show, about 5 years. Obviously, people don't realize at times, I guess, that this is not something by which you can lose your house. Right? I mean, that's what everybody's thinking. I might lose my house. This is a problem. What happens when I die? Could you just explain or re-explain for the audience exactly what the reverse mortgage product is and how it works?
Sure. There are a lot of misconceptions. So, number one, a lot of people think of a reverse mortgage as a loan for, last resort. And that's really not the case. Most of my clients right now are financial planners, and I work with a lot of seniors who are trying to figure out, how to get an additional funding stream in retirement years.
Right.
And a reverse fits that need. But a lot of people are concerned that they're going to lose their home. So a reverse mortgage is basically set up that it's an FHA-backed loan, which means it has mortgage insurance. So you'll never owe more than the value of the home. So let's say the market, goes in a downfall and you have to sell the house, and you owe more than the value of the home. You never owe more. So we would always work off of the appraised value, not what is owed on the statement. So,
okay.
A lot of people feel that the bank's going to take the home. That's not the case.
Give us an idea of how you qualify. Give us like the top 5 things you need to qualify for a reverse mortgage.
Sure. You obviously have to have some equity in your home.
Okay.
Normally it's 62 years or older, but we have a new product now coming out that's going to go down to the age of 60.
Right.
So at least one person as of right now has to be 62. You have to be able to off the mortgage in the reverse mortgage, have enough equity built up in the home.
Right.
And income qualification means that, we do have minimal income requirements.
And that's to pay for the taxes and stuff like that?
Yes, yeah. So what we do is we actually look at how many people are in the household. So let's say there's 200 people in the household, and depending on what state, there's a specific number, which is what they consider residual income.
Oh, I see. Okay.
So, if you let's say you make $3,000 a month, and you have no debt, and your taxes and insurance is $100 a month on the average, and you're one person, so figure residual income would be the $600 plus the amount of money that it takes to upkeep the house, so it'd be $700. You'd well qualify.
Okay, excellent. Any credit score requirements for this type of loan?
None. No credit score requirements. However, if there are adverse credits in the past 12 or 24 months, the lender might insist that you have a RISA, which is a taxes and insurance set aside.
I see. And what kind of counseling? I heard there's a bunch of counseling that the borrower has to do. And what's the cost on that?
So the cost fluctuates. It's normally about $150, $125 to $150.
Okay.
And the counseling isn't really it's a safeguard put in place, and that's to protect our seniors against misinformation. So if a client sits with me, I go over their information with them. They go to the counseling. The counselor should just reinforce what I've said to them.
Right.
It's just a safeguard in place.
Okay, so the protection is on the senior citizens through the counseling. You go through the whole program with them. There's a set of, 4 or 5 things that they have to absolutely start with. And how long does the process take, and how much does the rate cost? So
the process takes approximately, it can take 30 to 45 days. Of course, it depends upon, the amount of time it takes before they can get their counseling done,
right,
on the appraisal. But, I would figure 45 days.
Okay.
And there's only out-of-pocket fees, and that would be for the counseling and also for the appraisal.
Okay, very good. Now, there are some unusual twists or different products that the reverse mortgage has. We were talking off-air about some of the jumbo reverse. What is that?
So, basically what happened is that people with higher value homes wanted a reverse mortgage, but, they weren't getting enough out of the standard HECM. So a lot of companies have now come out with a private reverse mortgage. It has all the same benefits as a standard HECM, except it has no mortgage insurance. It's just built into the rate, and it goes up to $4 million.
So as long as you meet the equity requirements in the house, whether it be, 45, 50%, is that still what it is?
Depending on the age, but yes.
Okay, then you could possibly pull the rest out in cash?
Yes.
Well, that seems like a very good deal. I mean, especially with the house prices in San Bernardino, Riverside, the way they are and the way they're going up, seems like anybody out there who is of age who needs some cash for either, investment for some residual income in retirement, or just needs a big piggy bank, sounds like a pretty good product.
Well, I have to say that, the one part about reverse mortgage that makes a lot of people stand up and take notice is the line of credit.
Mm-hmm. I see.
Using a reverse mortgage as a standby, that has a growth rate of approximately 5%. To watch that compound against itself over the course of years has some of the greatest financial planners looking at that, thinking that this is a great standby product.
Wow, that's excellent. Nina, could you shout out your phone number for me, please?
Sure. It's 480-635-2410.
Okay, this is Nina Penny, and she's a terrific reverse mortgage specialist as well. You do forward loans as well, right? I mean, you're full service.
Yes.
Okay, excellent. And for those people who are listening right now, her telephone number is 480-635-2410. Nina, thanks very much for coming on the show. Really appreciate it. Want to have you back because as we get tighter in the economy, the reverse mortgage product is probably going to look better and better to a lot of people.
Absolutely. Thank you, Jeff.
Thank you very much. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We talk about mortgages. We talk about real estate. We talk about anything and everything to do with how are you going to get your next house? What are you going to do if you do get your next house? And are you going to stay in that house for a long time? All these questions are really important when you're trying to get a mortgage. Mortgages are easier yet harder to get, and I'll explain that probably in a later section. But in terms of some of the things other than a standard fixed 30-year loan, you can get all kinds of non-QM, and that's qualified mortgage. We've talked about that many times on the show, and we've talked about the solutions that a lot of our different lenders and lending partners bring to us. One of those, of course, from ACC Mortgage. We've not had her on the show before, but I really appreciate it. Kelly Brown. Kelly, how are you today?
I'm doing great, Jeff. How are you today?
You know what? I'm a little stressed, and I'll tell you why. The market is not cooperating with us, and we're losing borrowers to the difficulty of getting loans. So I wanted to have you on the show to tell us what your company is doing to try to help me and my borrowers get loans in a better or easier fashion. And really, that's all. I'm just telling a story here, right? So really, I'm just asking you what's happening with your business, and maybe give a little background of who you are in ACC for the people who don't know you or them.
Sure. Well, my name's Kelly Brown. I'm a senior account executive with ACC Mortgage. We're based out of Rockville, Maryland. I'm actually out of California, though, Newport Beach. ACC Mortgage actually stands for All Credit Considered. We've been in business for just almost 20 years. I made it through the crash and everything. We are a non-QM portfolio lender, and we actually, our niche products are foreign nationals, I-10 programs. We can do 12 and 24-month bank statement programs. We have an asset depletion program, and we have a NEVA program standing for No Income Verification of Assets on purchases and refinances, and then a NINA program, which is no income, no assets on refinances. We specialize in non-warrantable condos, and we can do large acreage up to 10 acres as well.
Let me ask you a question. That's a lot of products, and I want to focus on the NINA, No Income, No Asset program for a second. Tell us a little bit about that. What kind of equity do you need in that? And the reason I bring that up is because we have a large and varied audience that listens to the show. But anytime something sounds as good as this kind of program, it reminds us a little bit of 2008. So tell us a little bit about the program, how the protections are built in for the market, and what kind of customer you're looking for.
Well, this would be for self-employed borrower, most likely. And the application would be actually blank on the income part and blank on the asset part. And it's only applicable, like I said, for refinances. So they can't purchase a home using that program and product. It would be based off of our investor rate sheet, and depending on credit, the interest rates would fluctuate. But in most terms, it would be for the person who has at least 20% of equity in their property. And then they could move forward with that loan to get a loan proposal from us.
Now, is this the type of loan that may be a bridge loan to getting a conventional loan or some kind of a standard portfolio product, not portfolio product, but a standard Fannie Mae or Freddie Mac loan, meaning that maybe you were in the market for hard money at one point, now you want to bridge that, get a lower interest rate possibly towards your ultimate goal of getting a Fannie or Freddie loan?
Yes, that's one opportunity you could use this program for.
I see.
And you're not going to have to pay like you said, it's kind of a bridge between hard money, non-QM, going into Fannie and Freddie, regular conventional loans. And you're not going to be paying a hard money rate, which would be much higher than the rates that we're offering on our investor rate sheet for this NEVA and NINA program, because the rates fluctuate on the rate sheet anywhere between 5.99 on up. worst credit scenario, which would be 620 FICO score to
Okay.
8.99, and those would be the par rates.
Of course, and because, hard money could be anywhere from 10 to, 14%, depending on exactly your credit score, the amount of money in the deal, a lot of things. So this could be that medium ground. What kind of borrowers look for this type of program? You said self-employed, obviously, but who else would be a good candidate for this kind of program?
A person that's not showing a lot of income on paper, but might have a heavy cash flow coming in as income.
Right.
And like I said, probably most likely the self-employed.
Right, exactly. So when did you guys roll these programs out?
Oh, I believe they were rolled out about a year or so
Okay.
prior to me coming on board.
I see. And how are you doing with them?
Great. It's one of our hot products. I mean,
I bet.
yes, especially the NEVAs, because you can use those for your second homes or investors. Cannot use these programs on primary residences, though. I have to emphasize that.
Okay. So these would be what, investor properties?
Investor,
Mhm.
yes. Second homes.
Investor, second homes. Okay, both of those things are obviously what we led off the show talking about. How do we get residual income long term, especially when you've got maybe some disasters in your family, you got education you got to have paid for. So there's all kinds of reasons why which you need income property, and this would be a perfect example of what you could use this loan for, right?
Yes, exactly. And we can actually use this particular loan product, the investor product, on 2 to 4 units, condos, and also non-warrantable condos as well.
Tell people what non-warrantable condos are, because you hear that, and you only really need to know it when you can't get a loan, because it's a non-warrantable condo. So tell people what that is, and maybe provide them with the solution that you have too.
Yeah, it's based off of the particular condo project and how many investors have actually bought into the project versus how many investors are actually or have bought units and are actually living there as a primary residence. And usually a questionnaire has to be filled out, and then depending on how the questionnaire is answered would determine whether it's a non-warrantable condo or not. But the good news is at ACC we can do non-warrantable condos pretty much 99.9% of the time.
Now, there are certain places around the country. I think Florida is one of the places you guys do business, right?
That's correct.
Okay, so in Florida, as well as a couple other places, the condo market really sank when the economy hit the skids. And I don't know if they have come back 100%, but a lot of the problems of these condo associations were that they were underwater, they were underfunded, and there was, no lender who would lend in situations like that. Is that what you're talking about a little bit?
Yes, that's correct. Because of the crash and hurricanes and so forth down
Right,
in
of course.
the market as well have an effect on that. So a lot of lenders are a lot more strict due to that fact. So that's one of the advantages to considering us. If you're considering to purchase a non-warrantable condo, we can do those loans for you.
That's interesting. The weather-related elements that you mentioned, yes, there's a bunch of them in California right now with the fires. How are you guys handling that when you are in escrow or somebody wants to use a loan in a particular area that has been either ravaged by flood or fire or hurricane? What happens in those circumstances?
Well, it has to be looked at very clearly by our senior underwriter and analyzed and so forth to see if we'd be willing to lend in those weather restricted areas.
Sure. No, and I understand that. Obviously, nobody wants to lend where they, are in danger of either losing the house because of the hurricane or fire or flood, or never getting their money out because there is no more unit anymore. Listen, Kelly, thanks for coming on the show. We are up against it. That was a very quick 10 minutes, but I do appreciate you spending time with us, educating everybody about products over at ACC.
Thanks so much, Jeff.
Thank you very much, and I'm Jeff
great
Barton.
day.
Oh, and you too. Thank you.
Okay, thanks.
You're welcome. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. And pick up the phone and give us a call. We are here each and every week answering questions about your mortgage and what you need to do to get a mortgage, or maybe you want to refinance a mortgage. Although, if you're one of these people that hasn't refied by now, I have something to say to you, but we have to do that off air. We can't do it on air. The reason is that we have got rising interest rates. We have had a federal open market committee meeting just say recently that they're not going to raise now, but we are looking forward probably to September raising, and possibly again in November. So listen, rates are very important to your mortgage. You probably know this, but if it goes up an eighth of a point or a quarter of a point, it could cost you tens and thousands of dollars over the term of your loan of 30 years, maybe even hundreds of thousands of dollars if you've got a high-end loan and you've got a 30-year mortgage term. So don't be silly. Pick up the phone. Give us a call. I really appreciate it. And also, if you want to contact us by email, it's info@malibufunding.net. My Twitter handle is @Jeff6493. We're on YouTube. If you go to YouTube, type in the channel, which is Jeff Barton, the real estate voice. And each and every week we do bring to the show some interesting and great guests. We try to bring both people who are knowledgeable on the origination and also those who help us secure mortgages for borrowers, i.e. lenders themselves. And from Sprout Mortgage today is Dennis Kelly. First time on the show. Dennis, thanks for coming on the show.
Jeff, thanks for having me today.
Yeah, thank you very much. And I do appreciate it. I know that your time is valuable. Tell us a little bit about what's happening with Sprout.
Sure. Well, Sprout Mortgage is what they call in the mortgage industry non-agency lending. So what we look at are loans that typically a normal lender might pass by. Maybe there's somebody that had a recent credit event, maybe a life event happened, such as a divorce or loss of job, medical event. So we look at people like that where they're not able to enter the market back with traditional financing mortgage products, and we'll take a second look and potentially give them a chance to get back into the real estate ownership part of life a little sooner than they would do it with traditional financing.
You know,
what we do.
I'm sorry, go ahead.
Yeah, but just there's a few more things. I'll just briefly touch upon them.
Sure.
But other areas that we focus on are self-employed borrowers. A lot of times Uncle Sam affords opportunities to self-employed borrowers where they can write a lot of expenses off their real estate taxes. Well, when you get into the nitty-gritty of it, traditional mortgage lenders, they're not going to qualify. But we can do alternative documentation qualification. Maybe we look at their bank statements and so forth. So there are a lot of things for investors, for people with recent credit events. Anybody that falls off of the traditional financing means, a lot of times they may have a home with us at Sprout Mortgage.
Great. And you lend in all 50 states?
Well, we are in 45 states.
Okay.
For the most part, we're in every major populous state.
Okay. Yes, I know those other states. I used to have licenses in those states, never did a loan, and so I don't have licenses there anymore. I know exactly where you mean. And
Certainly.
You as an AE, you've been in the business a long time?
Yes, over 20 years.
Wow. Really? 20 years? That's great, because I don't know if I could be in it 20 years. I'm almost 20 years. Actually, I'm over 20 years. What am I saying? I'm in the real estate business and mortgage business 20 years. But it's a stressful business when you're dealing with people who are making the biggest financial decisions of their lives, and everything kind of hangs on you, especially when you're dealing with non-traditional buyers and perhaps, people that are submitting packages that have to be underwritten manually. How do you handle the stress? How do you manage the process from beginning to end, and keeping the buyers, satisfied that the process is at least fair, if not positive?
Well, one of the things that we focus on, Jeff, at Sprout Mortgage is looking at everything on the front end and considering any elements of the loan as early in the process as possible to eliminate any of the potential pitfalls or surprises that may arise later in the process. The last thing a borrower wants, a purchaser of a home, would like to hear is they're getting close to moving in and they find out, well, this certain document disqualifies you from the loan. So we try to be, in one word, be proactive in the way that we consider these loans. So from the very beginning, if we're talking to loan officers and brokers, we do what's called a pre-qualification, which I know you're well aware of. But let's look at all the elements. Let's put everything on the table. If we need to disclose something at the beginning, let's consider it. Because a lot of times we can maybe have workarounds to certain situations. Maybe we can mitigate the risk. But if we're finding out about it later in the process, our hands may be tied. So one of the things that we really emphasize is being proactive. And then two is over-communication. Whenever these processes are going on, particularly for borrowers that potentially have never heard of these type of loans, they don't know what to expect next.
Right.
So if we can over-communicate, set the expectations, and make certain continuously throughout the process, everybody's aware of where we're at and what are the next steps.
Give us an example of something that would be a stumbling block late in the process that nobody had thought of before. And the only reason I bring this up is because it happens all the time. Well, not all the time, but it happens occasionally to even A-paper loans. They're just something stumbling block that just they can't get over. Give us an example of something like that.
Sure. I mean, I can give you a few quick examples.
Great.
Let's say, for example, you had a loan for an investment property, but you thought that you didn't personally guarantee it, and maybe you had a short sale. Something happened and you let the property go a year or two ago. Well, if we're doing a background check later in the process and we find out there was a short sale or a foreclosure, that might disqualify you from the loan that you're applying for. So it's important, for example, on that, that you get that to us as early in the process as possible. But also for some of these self-employed borrowers, we may be looking at quite a few months' bank statements.
Right.
And if there's something that's changed in the financial picture in the recent bank statements that wasn't disclosed to us, that could maybe disqualify you from an income standpoint. So there's just a whole host of things. So you want to work with a broker or a banker that you trust, and then obviously the broker or banker works with us, the lender, that the whole value chain, just the continuous communication throughout the process will help eliminate or mitigate some of those steps.
Now, the fine line between...
As you said, loan officers, that's how they feed their families.
Yep.
So sometimes the people that aren't producing that much will go through means that otherwise they may not go through to get loans done. So specifically in our product group, yes, there is increased risk for fraud, but there are many more fraud mitigating mechanisms in the marketplace today that didn't exist 10 or 12 years ago, such as verification processes. Yep. You know, and there's just a lot of things that were leading up to the subprime meltdown. They didn't exist back then.
Right.
Now they do. So even as much as going to the appraisals and using appraisal management companies versus going to an appraiser and buying a value. If you can't give me XYZ value, I'm going to go to the appraisal next door. So those type of things help to minimize the fraud. They don't eliminate it, but they do help to minimize the fraud.
That's great information, and I totally agree with you. I mean, when I ask this of some people, they get a little upset with me just because, hey, I'm on the radio and you're asking me questions about fraud. Well, it's a factor of life in our business, and we always have to caution buyers and borrowers about documentation and the penalties that come with it, because, quite frankly, my license is on the line, and 20 years in prison and $1 million fine is no joke. So we want to make sure that everybody in the business knows really that honesty, being upfront, and disclosing is always the way to go, because there is an answer to most loan issues.
Yes, and one quick story I can tell you about about 13 years ago, when I contacted the FBI about fraud. The FBI replied to me. There was a property there was no property, the appraisal appraised the no property, title, HOI, everybody was involved in it. The FBI's response to me was, Dennis, we can't do anything about it. We don't have the manpower because they were so focused on terrorism. Right. Well, after the meltdown, they now have, as most people know, they have a special division towards mortgage and financial fraud.
Yep.
So I've been in contact with the FBI since then on things, and they're very motivated to pursue any type of fraudulent activity. So we all know people that went down the wrong path, and it's not something from a borrower or from a LO standpoint that you'd want to follow.
Excellent. Hey, listen, could you shout out your phone number for anybody who might want to talk to you about some of these great products?
Sure. So our phone number, it's a toll-free number, available 7 days a week. It's 888-943-2833.
Okay, just 1 minute left. Can you tell me, do you guys hold on to your paper? Do you sell your paper? The reason I ask is because liquidity in the non-QM space is always of issue to me, because I want to make sure that, people continue to have the opportunity to borrow money.
Yeah, so, we do sell all of our paper. If you're not selling your paper, you're not going to get the most aggressive term. So if somebody came to me and said, I want, say, a 5% rate, and I want you to hold the paper, guess what? If somebody's holding the paper, the rate's 9%.
Right.
So you're not going to get as an aggressive comp or rate if you are holding paper. Now, as far as liquidity, there is so much liquidity in the non-QM market. Investors are starving for it. The default rate on this non-QM paper is approximately the same as conforming default.
That's amazing, isn't it?
So when you get a higher weighted average, it's a good product. It's not yesteryear's subprime product. It's much different. The risk is mitigated and fraud is minimized.
Dennis, thank you very much for coming on the show. This has been Dennis Kelly from Sprout Mortgage. I really appreciate it.
Thank you, Jeff. Have a great day.
And you have a great day, too. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's the telephone number. If you pick up the phone and give us a call, we will answer your questions about mortgages. If you want to email us, info@malibufunding.net. We are on YouTube. If you go to YouTube, the channel is Jeff Barton, the Real Estate Voice, and you will see hundreds of shows there about what we talk about here, and also on our Las Vegas show, which talks about the market out in Las Vegas, the real estate market, and the opportunities out there. There are a number of opportunities all over the real estate world right now. We're seeing some flattening in prices. We're seeing mortgage rates kind of steady, although they will be rising more this year. I think we'll probably get another half-point raise, and by this time in 2019, which is really what we talked about last week's show, we might see a point higher in terms of the mortgage rates. So if we're at 4.875 to 5.25% now, well, we're going to be at 5.875 and 6.25% in that range a year from now. The agency loans, government loans, non-QM loans, they are all products designed right now to try to maximize the number of borrowers in the system. What we have for most of the major lenders, maybe you've paid attention out there and seen what's going on. There's a lot of mergers and a lot of acquisitions, what they call M&A. And the reason for that is that we have a very limited amount of loans. Now, when I say limited amount, we're talking about $1.7, $1.8 trillion in loans. And that sounds like a lot of loans, right? But if you're comparing that to the year before that, when we're doing close to $3 trillion, you can see that what we've had is a 30 to 35% contraction in the mortgage market, in the mortgage origination, and that affects everybody across the board, from large companies that have overhead, whether it be a bank, whether it be a mortgage banker, whether it be heavily invested software solution companies. I mean, even look at Rocket Mortgage. Rocket Mortgage came out, I don't know, about 2-3 years ago, and they were solely aiming for the millennial marketplace, and they were just hammering their advertisement. Well, they've since cut back that particular ad campaign, and they're really going for Rocket Mortgage is a component of Quicken loans. So they're combining both. Why? Because there's only so many millennials out there, and from what I've read recently, the millennials have kind of given up on the market, a lot of it, because they just can't afford it. And being the fact that the real estate prices keep going up, and what we have also is mortgage rates going up, they just say, forget it, I don't want to do it anymore. I'm out. So if the millennial market, which is the largest market in the United States, it's the largest mortgage market ever, really, if these people got into the marketplace, but they just don't want to. So all of this means that mergers and acquisitions, buyouts, straight people getting out of the loan business, that's happening right now. And as a result of that, well, we're going to see some contractions continue probably until late into 2019. And when that happens, we might see a little bit better in terms of rate and a little bit better in terms of compensation. The compensation, which really is the independent mortgage broker, the independent mortgage banker, and the non-depository institution's lifeblood. I mean, the compensation means I have a loan and I'm going to sell it to you and you're going to give me money. That's what it means. It's not about originating the loan to the borrower who then borrows the money from you. No, it's on the back end of the transaction when you have the loan completed, and then you sell it to any number of different places. And that's true for anybody in the origination business. Well, all of us depend mightily on origination compensation. The compensation that is given to us is regulated very heavily by the CFPB, Dodd-Frank, and the individual states. So if we have mortgage origination down, and by the way, 1 in 9 people in the United States work in the real estate business. Now, when I say real estate business, I mean the construction business, the mortgage business, the title business, the escrow business, sales, real estate agents. All of these components that go into real estate, whether it's new home sales, whether it's tract home sales, whether it's existing home sales, townhomes, condos, mobile homes, you name it, timeshares, all of these things that are comprised of the real estate market, land sales. I mean, there have been a number of large land sales in Southern California over the last 4 or 5 years, looking for the opportunity to go out and build thousands of homes. And they're trying to continue the track, which was up through Palmdale and the Victorville area. At one time, there was slated to be 250,000 new homes up there, and that kind of got killed during the last recessions. But if you're in San Bernardino and Riverside right now, and you're looking around and trying to figure out what the best opportunity for you is, as I said in an earlier segment of the show, best thing to do is kind of wait right now. And why do I say that? Because we've seen a softening of the real estate prices, and we are going to see a flattening of the mortgage rate between hikes. So we had a little bit of softening on mortgage rates. And again, mortgage rates are still pretty low. If you're looking at $500,000 mortgage at 5%, that's still pretty low. And I mean, that's a 5% of 500,000 is 25,000 simple interest per year. So you divide that by 12, and your payment is probably anywhere from $2,500 to $3,500, depending on what the loan product is, which is still very affordable for a property at $500,000. And a $500,000 price tag in certain cities can buy you a mansion. Now, in other cities, it can't buy you anything. I mean, you go to Rancho, you go to some of these other very high-end cities in the Inland Empire, and you're not going to be able to buy much with $500,000. But for most people in the areas that we're talking about, $500,000 is pretty good. I think you will be able to afford a very nice house for that, and I think we will see real estate prices softening somewhat. A couple of the news to use sections here. 9% of U.S. homeowners are underwater on their mortgage. Interesting to note that even though, and there's been a lot of articles recently about the recession and what happened and what has happened since. It's been 10 years. You think about that right now. It's 2018. In 2008, we were looking at the collapse of some major banks, the mergers of some other larger banks, institutions like, I don't know if anyone remembers Countrywide or some of the other larger institutions that are no longer around anymore, Goldman Sachs. Just think of these really mainstay companies of the 90s and the early 2000s that just aren't around anymore. But we are still feeling the effects both in the economy and in houses that are underwater. Did you know that across the U.S., Daryl, did you know this? 10% of the homes across the U.S. are still underwater, meaning they owe more than the house is worth.
Oh, I certainly believe that, yeah.
So if you consider that number is about 4,100,000, is about 45 million homes in the U.S. and that are owned by obviously a borrower, and 4,100,000 of these homes are underwater. That seems like a lot to me.
That's a substantial number, and obviously there's going to be some action taken on those homes at some point or another, and it's going to put those people eventually out of the street. And once they're on the street, there's got to be a whole another raft of activity to get them back into some sort of housing.
Now, some of the cities that were really underwater during the recession, places like Las Vegas and Detroit, Phoenix. Let's see some of these others on this list. A lot in Missouri as well. Surprisingly, St. Louis, for instance. Well, St. Louis, Missouri today has 12% of their properties underwater. 12%. That's a lot.
Which is above the average.
It's above the norm, exactly right. But some of the cities, like Chicago, Illinois, they have 15% underwater. Another city, well, you can tell.
Big numbers, yeah.
Well,
Detroit probably as well.
Let's see, what is Detroit here on this list? Detroit, 10.8%. Yeah, that's above
they
average.
haven't come back from, the auto industry failing there.
But interestingly enough, look, San Francisco, 3.1%. There's still properties underwater in San Francisco.
San Francisco is a very expensive town to live in.
The most expensive town, I think, in the U.S. is.
I believe that's true.
Yeah, I think it is too. So, just another
rent a couch, $1,000.
Yeah, exactly right. Let's see. Okay, this is what I was talking about. 14% of all listings in June saw a price cut. This is from Zillow. So 14% of all the homes listed on Zillow saw a price cut. Now, I don't know how many millions of homes are on Zillow, but that's a big number because it's up from 11.7% in 2016.
And then there's the people that say they listed, and 3 days later they got 10 offers, and you had to go cash above the listing price to get the house.
Well, I just think that there's a trend. It's not an avalanche. It's not like something that's going to be happening to everybody. But the softening in the real estate market is a good thing, because what we need more of is cheaper real estate, so that we can bring millennials back to the market and bring people back to the market who really want to buy but currently can't afford it because the prices keep going up.
No question. But part of it is the lack of commitment from employers anymore anyway. I mean, it used to be you took a job somewhere for life and permanently lived in a city. That's not the case anymore.
Listen, I'm Jeff Barton. Darrell, thanks very much for jumping in. Appreciate it.
Pleasure.
Okay, very good. I'm Jeff Barton. I'm your voice in the real estate market. I really appreciate you listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.